Welcome to the Standard and Rich podcast, where finance meets fun. Join your hosts Danny Gallo and Jonathan Elkoubi as they navigate the complex world of finance with a touch of humor. Whether you're a seasoned investor or just starting out.
Welcome back, everybody, to the Standard and Rich podcast. Joining you today is your hosts, myself, Jonathan Elkoubi, and Danny Gallo. Let's start off this episode with a quick market news segment. Danny, let's start us off with market news.
Hey, how's it going, guys? So, a couple of news this week. We have the Great Wall of Bezos. So, if you look at the past 5 days, Bezos has been selling $5 billion in shares at around the share price of $200. So, if you go back in your app and you look at the past 5 days, you'll see a direct line at 200 that does not get surpassed and goes right back down. It's Bezos, actually, if you look at his filings, selling his stock at that price. So he's around 20% through all his sales. So you still have 80% left to go on the Great Wall of Bezos. There's also something that we talked about last week, and Jonathan, I think you'll be pretty ecstatic about this. Well, Tesla has closed green the last 10 days in a row. So from minus 43% year to date, it went up to 6% year to date. So massive movement on Tesla. I think short sellers have lost, $2 to $5 billion on their Tesla shorts recently. It still remains one of the heaviest shares shorted for Tesla all time. And yeah, it's just been ripping. Just a lot of positive headlines coming from Tesla. And we will see even more in, I think it's 2 weeks when they report their earnings, 2 or 3 weeks when they report their earnings, how that's going to go. And then in less than a month, so literally 30 days, we're going to have the robo-taxi unveil. So that'll be pretty exciting. So there's a lot of good news coming out of Tesla, a lot of positive media coming out of Tesla, which is great. You also have in China, one of the first government services have purchased Tesla as their government car. So there's a lot of positive headlines. Tesla is viewed perfectly in China. They don't see them as the government, doesn't see them as confrontation. They see them as a company that could come help the economy. And I guess you're just seeing that with all the types of deals that Chinese government is doing. And plus, they're opening up a mega factory in China as well to produce mega packs. There's Boeing that pleaded guilty this week on on 2 charges. If I'm not mistaken, they're paying $250 million in fine. They're also, let me just pull up the detail here. Yeah, so they're going to be paying fines for those 2 crashes. They also have to invest money into their safety department, and as well they need to have a independent, pretty sure an independent viewer from the government or just the Justice Department reviewing all their just seeing if they're doing the right things for security on the planes. As a fast pace, and they do need to produce more money because there's short-term debt should be hurting them pretty soon. But at the end of the day, they are too big to fail. The government's never gonna let Boeing fail. It's too important for the American government. Did you have any news for this week?
No, I did not have any news that I had taken down note of, but I think we could move on to our portfolio critique analysis part of the show. So we're bringing this new thing. We're introducing this to you guys. So we're going to be critiquing people's portfolios, see what they're doing wrong, see what they're doing right, and just going to give you guys a guide on how you guys should manage your own portfolios. Remember, this is not financial advice. This is for entertainment purposes only. So, Danny, you want to introduce who is the guy that we're critiquing today?
We will be talking about Bradley Talks Money. So if you're on Blossom, guaranteed you've seen this guy post or he's commented on your post. So we will be reviewing his portfolio, up 2% all time for the master analyst of everybody's portfolio.
Okay, so let's start off with his bio. So his bio says, Value Town. He says, true value is friendships we make along the way and buying businesses on sale. So he claims to be a value investor, and he also has his YouTube link, and he has Proverbs 13:11. And if you pull that up, Proverbs 13:11 says, wealth gained hastily will dwindle, but whoever gathers little by little will increase it. So he's basically saying fast money won't last, and if you play the long-term game, you'll be successful. Let's see if he does what he preaches. So what does his portfolio activity look like recently?
So he's made a few buys. One that I find pretty weird is that he sold Lightspeed at 18.22 at a 40% loss. And he went back inside recently, I think 8 days ago, at 18.60. So I guess the value is better at 18.60 than... Sorry, 18...
So he bought it higher than what he sold it at.
Yes, exactly. So it was overvalued.
It was overvalued at 18.20, but it was undervalued at 18.6. 60, sorry.
Sorry, yeah. Go ahead. Keep it going.
Okay, so I think his longest investment that he has currently holding is from 2 months, right? The 2 months is his longest investment that he holds right now, and that's his longest holding period is 2 months. He claims to be a long-term investor. He puts Proverbs 13:11 in his bio, and his longest investment that he has right now is 2 months. So if you look at his all-time return, it's only 2.1%. And we'll break down the companies that he owns. So he has AMR, Alpha Metallurgical Company, Alpha Metallurgical Resources. So this company has exploded in the last 5 years. It's up 2,300%, 2,300%. But our friend Bradley did not capture any of that gain. He's sadly down 1.6%. So yeah, that's good for him. It's a commodity business, very risky. I don't know if you can really value it accurately because of the commodity aspect of the business. But the P ratio is not that bad. It's 570 million profit for a $4 billion market cap. Not too bad. Not too bad. It's like a 9 or 8 PE. Not that bad. Balance
what
sheet
about their short-term debt?
Their balance sheet doesn't look too weak. They don't have that much debt. They have $7 million in debt and $4 million in short-term debt. So not a big problem there. $1.5 billion in shareholders' equity. So they're trading at 3 times book around. Cash flow negative. Oh no, sorry, I'm looking around there. So they have $606 million free cash flow, and it's been growing, but not at the pace as their stock. Their stock has grown to 2,000%, and their net income has only 3x'd in the same time period. So a lot of this doesn't add up, doesn't really make sense to me, but let's move on to the next stock. So that stock, AMR, was 25% of his portfolio. So this guy's very not diversified. He's the opposite of diversified. It's very concentrated. So what's the next holding? It's Aritzia. He owns 24% of his portfolio in that. It's a pretty fast-growing company. Decent balance sheet, decent everything. I just think it's a bit overvalued. He claims to be a value investor. It's like a 52 PE right now. Let me check. Let me check the PE. 58 PE. I was wrong. So this guy claims to be a value investor, but I mean he's investing in this rich PE. It's a decently fast-growing company, but it's a very rich PE for what it is. I don't think that's a buy at that price. So let's look at the next stock, Brookfield Asset Management. This is a very popular company within Canadian investors. I see it all the time in people's portfolios. I never understood why, though. He's up 4.9% on this. It's 15% of his portfolio. This company has decreasing free cash flow, decreasing profit margins for the last 10 years. Not profit margins, profit itself and profit margins. Their revenue has increased a lot, but their profit has decreased. So it doesn't really make sense. In the last 10 years, their profits decreased consistently. And if we look at their balance sheet, it looks disgusting, like they're getting clobbered because they have a bunch of short-term debt and they really don't have enough cash to cover it. And most of their assets are, a lot of their assets right now, if we remove the goodwill and the intangibles, their equity is only 70 billion. So it's trading at around their market cap. So their market cap's around 70 billion too. So it's like 1-to-1, but it's basically like a financial institution. And I don't know, it's not really a good investment in my opinion. And not only is their profit not growing, but their PE is 71. So 71 PE for a company that doesn't even have growing profit, that doesn't even make sense to invest. Like, I only invest in high PE stocks when their profit's high. Sky high. I mean, when their profits are growing. So let's look at their next stock, Canadian Tire. He's buying Canadian Tire in a recession economy. It's 11.6% of his portfolio. He's down 10%. Inflation is high. This is terrible for Canadian Tire because this means when they buy their inventories, their prices get increased. Then they have to increase their prices on their customers. And then by the time they get the cash, their suppliers already increased the prices. So they have to put 100% of their money into the new cost for their new increased price goods. So it keeps rolling over and they barely get to keep any cash flow for the company itself. But it is a big company. Let's see the income statement. Let's see if the net income's growing. So in 2022, we had $1 billion net income. 2023, they got crushed all the way down to $200 million. And remember, again, we're talking a market cap of $8 billion. So $200 million profit for an $8 billion market cap. Got crushed. And they have $700 million free cash flow in 2023. Negative free cash flow in 2022. Kind of weird. So, I mean, it's growing, but it's going slow. It's a slow grower. You can't expect much from Canadian Tire. Yeah, and it's kind of, let's see their balance sheet. Let's see if it's financially strong. So we have $300 million in cash. Let's look at their debt. Short-term debt of $2 billion. Long-term debt $4.4 billion. Shareholders' equity $7 billion. Any intangibles? They have $1 billion of intangibles. $1.4 billion intangibles. And they have $800 million in goodwill. If you remove that from their equity is only at $5 billion. So not too good there. Let's go look at this guy's next investment. Lightspeed. Are you familiar with Lightspeed? I don't know what this is. Lightspeed.
Lightspeed, I know they do POS systems for restaurants and stuff like that. It's a software company. Yeah, that's it. So all-in-one retail POS.
Okay, so he's down 31% on that, and it's 9% of his portfolio.
Yeah, Lightspeed. I don't know. I wouldn't touch that business. There was this shady stuff with their accounting going on a few years ago. It went all the way to 140. What is it at now? 18. And it's been having such a hard time rebounding. I have some friends actually that work for Lightspeed. I don't know.
Well, free cash flow is still negative. They're never breaking profit for free cash flow year. It's getting more and more as we look at the numbers. And we got leading red ink all over the balance sheet. Show the balance sheet. Balance sheet, cash, and let's just see here. No debt. And equity of 2.4 billion. Not too bad. Just losing a lot of money. You're burning a bunch of cash, red ink everywhere. So it's kind of disgusting. Not a good investment for a value investor. Let's just say that. Okay, let's talk about Walt Disney. Is his sixth holding at 8% of his portfolio. He's up 14% on this. Congratulations. This guy's actually up on this. So let's go look.
But Disney had quite a good run. Then
I mean, I think Disney's a good company.
122.
Yeah, I think Disney's a good company. It's a good grower. If you want consistent growth, it's good. And they have a lot of valuable patents and like brand names.
Yeah, so it's at 100 PE, right? 105 PE.
Yeah, I was gonna message that. But yeah, the PE is very, very overpriced. 105 PE for what it is. I mean, it's not gonna grow that fast. Like, whoa, calm down. And they actually have shrinking.
The Disney platform too. It's not. It's losing money. I think their bread and butter is really the parks, but that's facing headwinds too. Now look, there's a story that just broke today that Disney faces strike threat as thousands of California workers vote on walkout. So at their parks.
Did they sell a part of their business in 2018?
I'm pretty sure they did sell something in 2018. Well,
their profit just dropped from like 10 billion to like 2 billion. So, just wondering how. Probably sold something.
It acquired 21st Century Fox December 14th, 2017, and that was completed in 2019.
I don't know. I wouldn't invest in Disney.
Yeah.
Kind of
and I think they've been flirting around selling ESPN as well.
And they just,
I think ESPN's just gonna. I don't know.
Well, ESPN just acquired Barstool Sports, right? Recently?
Yeah, Disney acquired Barstool Sports. Well,
through ESPN.
ESPN acquired, through ESPN, and they didn't want Barstool Sports, so Penn sold it back to well, no, that's it. They didn't buy the Penn. They did a deal with Penn that Penn would become the official sports betting for ESPN Plus. So they would do that project together.
And which
but in that
Penn
contract, I don't know what Penn Gaming. Penn Gaming platform. I think it's just Penn.
Yeah.
So, anyways, they sold it back to Dave Portnoy for $1. So he sold it to them for what, like 500 mil, and he got it back for $1. So the guy's laughing his ass off.
Yeah, he made a lot of money.
But if ever he sells his company, I think half the profits have to go back to Penn. But still, even if he sells the whole thing, he made 500 mil. Sells half, he gives half the profit of selling it again, made another 250 mil. The guy's laughing to the bank.
Yep. And Last investment, Allied Property Real Estate Investment Trust. So it's a REIT. Let's take a look at this. It's 6% of his portfolio is down 15% on it. Not a big holding. It's in the last 5 years, the stock has dropped 70%. It is 11% dividend. I'm guessing that's why he holds it. But their EPS is negative. Let's see if it's sustainable. So yeah, they're losing money 2023. And their cash flow is negative 2023. But they continue to pay the dividend regardless. So the debate is just whether it's sustainable. If you look at their balance sheet, it'll tell you. So they have no cash. Accounts receivable $420 million. Other assets. Okay, so $10 billion there in properties, and then $4 billion in long-term debt. It's kind of risky. I don't know. They're losing money, and it's a high dividend, but yeah, they're losing money. I wouldn't touch it. It's weird. But you were getting in arguments with this guy, right? You were getting in debates with him?
Yeah, we kept on getting into debates and arguments on Blossom. I would always end it with a one-punch line at the end, and you wouldn't know what to say. But yeah, like you said, there's a long-term profile, but you could see that it just makes a bunch of trades. So he's more of a short-term trader than he is a long-term trader.
And all of his companies have high PE ratios, like ridiculous.
Yeah, high PE ratios, exactly. By the way, just news came out. NATO agency places $700 million order for Stinger anti-aircraft missiles. So that's going to be bullish for Raytheon. The last time that they had this big of an order was 2 years ago, in May 2022. So that sounds pretty good
I think
for
this
them.
is a good time. We should move on to the stock picking segment of the episode.
Perfect, guys. Don't forget to click the links below to sign up on Wealthsimple and Questrade to start investing. You will get a free $25 and $50 sign-up bonus with any deposit amount over $1. And also, don't forget to like and subscribe our podcast. Perfect. So to recap the last few weeks, so we have 1 week left with the McDonald's versus Versa. So McDonald's down 2.9% and Versa is down 2.64%. The other one we had was Formula One, so F1 versus TDG. So F1 is up 2.3% and TDG is down 4.45%. And last week's episode, we had ISRJ versus Visa. ISRJ is up 1.39%, and Visa is up 0.84%. So we're doing pretty good, except for our battle from 3 weeks ago. But I'm sure we have 1 week left that could pick up from there. Actually, I saw the McDonald's value pack. It's not that bad for what it is. But
it's chicken nuggets and...
4 chicken nuggets, a choice of 2 burgers, like I think a McDouble or a chicken burger, and a soft drink and fries, I think it was.
Small drink and small fries.
Yeah, so it's not that bad. But you have Burger King right now that's doing 2 Whoppers for $5 too. So that's a pretty good competition. I know it because I ordered some this week. So yeah, so that's it. So we'll see if all these chains start battling out more and more, and try to acquire more customers. So because they've been having a hard time getting customers through the door, right? And when you use platforms like Uber, I don't know if they pay the full 30% to Uber. It would be nice. It would be interesting. Yeah, while I search that, you can start with your pick of the week.
So my pick of this week is, drum roll please. Actually, we don't need a drum roll. So it's Nike. as you guys all know, Nike has been getting a beating recently. And Warren Buffett once said, it's time to buy when there's blood in the streets. Nike is getting clobbered. Let me go check their stock price, but it is getting destroyed because of the relationship with their suppliers, and people are getting feared of their future, and they're scared that they're not going to grow. So basically, year to date, they're down 31.9%. Their P is at 19, and they're paying a 2% dividend right now. So fairly low for this company's history. If we look at the brand itself, it's a huge brand, huge conglomerate. They have a lot of athletes on their side, and I think that helps their brand a lot. They have Jordans, and they really dominate the shoe market. If you just walk around the street and look at people's shoes that they're wearing, it's mostly Nike. I don't know what the exact percentage of their market share is, but I'm sure it's like above 50. That's what I think. And if we look at the numbers here, let's go right away to their income statement. Net income is growing. We have $5.7 billion of net income. And we go to the free cash flow line. We have $5 billion free cash flow. So free cash flow is growing too. And what else? Let's go to the balance sheet. Make sure this is healthy. Short-term investments. We have $3 billion here, $8 billion in cash. Any debt? They have $6 million in debt, in short-term debt, and $9 billion in long-term debt. And then, they could pay that down easily. They could pay it down with just the cash that they have lying on hand. So that's really no problem. So they're financially healthy, and they have $14 billion in equity, which is really low for what they're actually valued at, because they're valued at $110 billion. But I think that's just because of how capital light their business structure is, and they don't really need, they don't need to have stores, they don't need to own the distribution centers. They just send them out to other stores like Foot Locker or Sports Expert, JD Sports, and other stores like that, and they also distribute it online. So they're becoming more and more capital light as we move more and more online. So I think there'll be less and less need for the equity. And that's my pick for this week because it's been getting clobbered. And I think it's a good time to buy when other people are selling. What about you, Danny? What is your stock pick of the week?
Just to come back on the McDonald's thing, I can't really find a number. It says it's between 15 and 30%, but I'm pretty sure it's not 30% because that's what just a standalone restaurant would do. So I'm pretty sure they're probably a 15 to 20% take rate. So anyways, I'm going to take Micron. The reason I'm going with Micron this week is just that Samsung is facing a strike on their side. Let me just come up with something here. Yeah, add a little bit of data to support. So Samsung and Micron, they compete in the semiconductor business, particularly in the production and sale of memory chips. So both these companies are major players in the DRAM, which is the dynamic random access memory, and the NAND flash memory markets, which are essential components used in a wide range of devices, including smartphones and computers. They also compete in production of SSDs, and both companies are involved in the development of other semiconductor products technology. So Samsung is the leader in this type of market. So in the DRAM market, they have around 42%. That's as of Q4 2023. And the NAND flash market share, they're around 32% of the market. Micron's 23% of the DRAM market, and for the NAND flash market share, they're around 12%. So Micron's been steadily increasing just a bit their market share for that, and so I guess they're taking it from smaller competitors. Samsung has relatively just stayed around that 43 to 32% respectfully. respectively. Sorry, on those two things. I just think that the more that we sell semis and that we have these data centers that are getting built, the more you're going to have to need these type of components from Samsung and Micron. And short term, I think there's a few catalysts that are going to be coming from Micron. So that would be my pick of the week. Do you have anything to add?
For Micron, no.
No. So I guess, guys, this will wrap it up for this week in the Standard and Rich podcast with me and Jonathan. Always don't forget to like and subscribe for the show. It gives us a little bit more visibility, and we like doing this show.
Before we go, a quick reminder. While we love discussing financial topics, we are not financial advisors. The information provided in this podcast is for educational and entertainment purposes only. Please consult with a qualified professional before making any financial decisions. Thanks for listening, and see you next time.